Hello, everyone. We'll be starting with our first lecture of corporate issuers. So, in the first reading, we'll be discussing what are the different kinds of organizational forms, like what is sole proprietorship, what is partnership, what is company form, how does these form differ from each other. So, organizational forms refer to how businesses are set up from a legal and organizational point of view. So, the meaning of organizational form is what? How are the businesses set up? How are they performing their day to day activities? Whether the business is separate from the owner or not, whether the business is separate from the owner or not, what kind of liabilities does the owner of the business have, how are they paying their taxes, whether they are paying their whether they are how are they paying their taxes, whether they are paying their taxes under the personal tax regime, or are they paying their taxes as corporate taxes, what is the kind of risk each and every owner holds. So on these parameters, there are different organizational forms. The first is the sole proprietorship. So this whole topic actually, corporate issuer would be on a theoretical side. So maybe you can combine any practical topic also with it, like the wherein you are expected to solve questions while studying, so that you have a good balance of studying theoretical and solving questions, and you do not even get bored in between. So what are the features of sole proprietorship kind of organization structure? It is a business owned and operated by an individual. So by the name we can see sole proprietorship. There's a sole proprietor, there's a single person who is owning the business and conducts the operations of the business. Legally, the business is an extension of the owner. So owner is responsible for everything which is happening in the business. The owner is responsible for all the liabilities of the business. The owner has an unlimited liability. So if the business ever undergoes, if the business ever goes into bankruptcy, so the owner may has to pay the debtors, the creditors, the amount from his or her own pocket. The owner receives all the profits and losses, and these profits and losses are taxed as personal income. Sole proprietorships are small in scale. Why are they small in scale? Because there's a single person, and there is no chance that that single person has the ability to attract so much funds, even if that person takes loans, but still you won't be able to attract so much funds. So they are generally small in scale. They are business owned, operated by an individual. They do not have any separate legal entity. The organization doesn't have any separate legal entity. It is just an extension of the owner itself. The owner has unlimited liability, receives all the profit and losses, which are then taxed as personal income. The second is partnerships. We have two types of partnerships. We have limited partnerships, limited liability partnerships. Then we have normal partnerships. What happens under partnership? Two or more persons, they come into agreement that they would be conducting businesses, and they would be sharing the profits and losses together. What is the difference between these two kinds of partnership? Now that agreement can either be oral, written, or just agreed upon. The difference between these two types of partnership is, under limited liability partnership, there may be certain partners who have limited liability. Their liability is limited to the amount which they have promised for. But under partnership, or if there are no limited liability, limited partners, all the partners are general partners. So all the partners have unlimited liability, just like the case of sole proprietorship. But what is the advantage when compared to sole proprietorship? They are relatively larger in scale, because there are two or more persons, so they would have more capacity to build in, to bring in more capital. So To do a business on scale that exceeds that of a sole proprietor, two or more individuals can form a general partnership. They can form a general partnership. In this structure, the partnership agreement would specify, there would be a partnership agreement. It can be oral or written. It specifies whatever responsibilities each and every partner has, what kind of money they have promised, what is their liabilities, are they general partner, are they limited partner, how are the profits and losses to be divided. So they have unlimited liability. In case of general partnership, they have unlimited liability. And profits and losses, profits are basically taxed as personal income. Now, in case there are any, in case of limited liability, there are two levels of partner. There is a general partner and there is a limited partner. Limited partners are those partners who have limited liabilities. Their liability is only limited to the amount which they have promised in the partnership agreement. They do not take part in the day do not take part in the day-to-day activities of the business. They do not take the decisions for the business. On the other hand, general partners are the ones who do not have limited liabilities. They take part in the day-to-day operations of the business, and they general partners take decisions for the business. Limited partners are not involved in appointing or removing general partners. So if any general partner has to be appointed or removed, limited partners would not be evolved. And how the profits will be divided between general partner and limited partner, that may be specified in the partnership agreement. Then comes corporation or limited company. Now, what is the difference between the first major difference between sole proprietorship, partnership, and corporation limited company is that it has a separate legal entity from its owners. That is, the company or the organization has the ability to hire people under its own name, fire people under its own name. The company would be paying its own taxes. The company is an individual or is an entity separate from the owners. The company has its own individual identity. All shareholders have limited liability. So all the shareholders' liability is dependent upon the capital which they have promised. So if the company ever goes bankrupt, any shareholder, any investor of that company would only lose that amount which they have invested in the company in the initial stages or the later stages, and not a rupee beyond that. Now, these can be more large when compared to corporate issuers because they can borrow capital. They also have access to ownership capital. So they are large because they can borrow capital, they can borrow debt, they have ownership capital, there are more people can bring in more money. There is a separation of owners and managers. Not every owner is managing the day-to-day operations of the business. So not every owner, not every person who has bought the share of the company would automatically be in a position to manage the day-to-day operations of the business. The day-to-day operations of the business would be done by the board of directors of the company. These board of directors would be hired by the owners. So the owners would be hiring the board of directors who would be taking care of the day-to-day operations of the business as you know and take care of the needs of the owners. A company can be public corporation, or it can be a private limited company. Public corporation is that the share of the companies are out there in the market and they are directly traded, but private limited company is similar to other public company, but it has a limited number of shareholders and their share are not yet out there in the market. Now, one feature of the company is the company faces double taxation. That is, whatever profits the company is generating, the company is supposed to be paying taxes on those profits. After that, if any dividend is also issued to the shareholders are also expected to pay taxes on those dividends as well. So how does double taxation affect the company, and how can a company reduce the impact of double taxation? So if a company issues less dividend, then the effect of double taxation also decreases. Let's see how. Earnings before tax, that is pre-tax earnings, were $100 million. 100% payout, 100% dividends were given, and 40% dividends were given. So the earnings before tax were 100 million. It were 10 million. Corporate tax rate is 25%, and shareholders are taxed at 20%. So first we'd be subtracting corporate tax income. So 25% on both would be paying. You'd be paying 2.5 million. We have paid 2.5 million, and after tax income is 7.5 million in both the cases. Now, this company is paying 100% dividends, and this company is paying 40% dividend. For 100% dividends, so you will be paying 7.5 million, and the shareholders have to pay 20% tax on the dividends. So tax on dividends would be here what? 20% into 7.5 million, which is equal to 1.5 million. And here the company is only paying 40% dividends. So 40% of 7.5 million into 20% would be the tax on dividends that the shareholders would have to pay. So this would come to 600,000. Now here, what is the total tax which has been paid? Total tax paid was 4 million. Here the total tax paid is what? 310 million, 3.1 million. So what is the effective tax rate? The effective tax rate is the total tax rate, total tax paid by the earnings, that is 4 million by 10 million. The effective tax rate is 20% here. Here the effective tax rate would be 3.1 million by 10 million. This is 31%. So the effective tax rate is less in the case where not every dividend is paid out. So the shareholders here hire board of directors, and in order to elect board of directors, the shareholders have voting rights. So they vote that which person they want in the board of directors. So the last topic is comparing publicly owned corporate company and private. So most public companies, they are listed. What is the meaning of listed? Listed means that they are listed on the exchange. Their stocks are publicly trading. People can trade into their stocks. So when the stocks of the company is publicly trading, prices of the stock is clearly known to the people. It is very transparent. So it is transparent, easily known to the people. They do not have to do any complex calculations. Now, when a company is listed on the stock exchange, there would have been many compliances that the company would have to follow first to in order to get listed. Now, in order to be remained listed, the company would also have to keep following these compliances. So, a public limited company has more compliances to be followed. So basically, the public limited company would give you better regulatory requirements. There would be better information out there in the market when compared to the private limited company. So the shares in the private limited company, they are not listed in the market. They do not trade on exchange. So whatever their value is, it is not readily observable. It is not that transparent when compared to the publicly limited company. So the transfer between investors is very difficult. You cannot just directly do the transfers. They have fewer compliances when compared to the private limited company. Now the shares of the publicly limited company that are free available for the normal individuals to trade upon are known as free float. That the shares of the company which are not taken up by the board of directors, shareholders, and everything, the remaining shares which are out there for the public are called free float. Now, how can private company raise capital? Private company can raise equity capital from private placements. They can call qualified investors or accredited investors and tell them that they want money, and this qualified investors can give them money as equity under through private placements. Now, the private company can go public by bringing IPOs, initial public offerings. They can even go public by direct listing. That is, they can just they are just listing themselves on the stock exchange. They are not bringing any new shares. So if they are not bringing any new shares, they won't be getting any new money. But under IPO, they are getting any new money. But direct listing can be done quickly without the many steps required when compared to IPO. The private company can also go public through SPAC, Special Purpose Acquisition Company. This is basically a company which is set up in order to acquire a private company in the future. Now, the name of the private company which will be acquired in the future is not known. So, whoever are investing, they are basically giving you a blank check that, okay, I'm putting in money in SPAC, but I am not sure what company the SPAC would be acquiring in future. So, that's it for first reading of corporate issuers.